Hello and welcome to this Markets Today special. I'm Udayan Mukherjee. With me is a very special guest who you don't see very often on television, the man who's taken on the mantle of Prashant Jain of HDFC Asset Management Company as the head of equity of the formidable asset management company. Chirag Setalvad is an old-timer in the market. He's worked with Prashant for many, many years, and now he is the head of equity at HDFC Asset Management Company, and he continues to run some of the largest funds of the AMC, like the Midcap Opportunities Fund, the Small Cap Fund, and the Hybrid Fund, among others. Chirag, great to see you on the show, and thanks for joining in today. And as I said in my introduction, you've got big boots to fill. You feel you're up for the job?
Thank you very much, Udayan, for taking the time to speak with us. Absolutely. I've been at HDFC since its inception. So I joined in 2000. It's been 22 years. I've seen us grow from a fledgling asset management company to the second or third largest. So it's been a fantastic journey. And in that sense, I've seen how process and systems have evolved over a period of time. And I think we've got a fantastic team. And while Prashant may have left, I think we're seeing a lot of stability in the rest of the team. We have fantastic fund managers and analysts. And I think with that support, we look forward to the next decade in terms of growth and opportunities.
Each CIO has an investment style or preference of his own. I'm sure as a team, you worked together for a long time, but Prashant had its own style of managing, his own preferences and things which he did not like so much. What kind of style change will you bring to the funds under HDFC AMC now that you are at the helm?
So I'm fortunate that I've taken over in an environment where we're doing extremely well. So in that sense, we've got tailwinds behind us. I think the last 10, 15 years, a lot of focus has been on systems and process. And I think the next 5, 10 years, we are focusing a lot more in terms of the softer aspects of culture, in terms of camaraderie, in terms of learning, in terms of international exposure. So I think there is a lot that we've already done. But the beauty of this business is that it's constantly evolving and there's constant learning. And I think in that sense, we want to focus a lot more on the soft skills within the organization. I think we've done a lot in terms of focusing on analysis and focusing on the harder aspects and the analytical aspects of the business. And I think now is the time to focus a little bit more on people and culture, and high performance cultures do give fantastic results. And we want to make sure that we are a high performance culture.
Your investment style personally geared towards value investing as well?
I would say it's a more middle path. So I think there are those who have more of a value tilt and those who have a greater growth tilt. And I would imagine that I'm much more somewhere in the middle. So I think the idea is to avoid, at least in my mind, fantastic businesses at obscene prices. But at the same time, we also want to look away from companies which are sort of poor quality businesses or managements, which may be available at throwaway prices. I think if we avoid those two ends of the spectrums, I think the rest is where typically I'm more interested.
So let me ask you about, say, something like information technology, which is in business, which is in focus this week because of, HCL Tech said something, and there's been lots of fresh worries about whether the sector can perform or whether some kind of ratchet down in valuation is required for the sector now. Where do you stand on a sector like IT?
So just to put that into context a little bit, we've seen IT had a fantastic run in the last 1 year, right? Barring the last sort of couple of months, and valuations had become quite expensive. And now we've seen a reasonable correction in IT stocks, and valuations have come to, I think, more reasonable levels. There is still a premium in the segment, and I think IT would still be trading at a 15-20% premium to its historical average. But I think a few things to keep in mind. I think IT spending is here to stay, and I think it's going to be quite meaningful even going forward. And I think the pressure which we faced from a supply standpoint, I think that supply pressure is likely to ease. So I think there's some pressure which is going to happen from a top line perspective, obviously, because you're seeing large global economies like the US and Europe, et cetera, slowing down. So that will put some pressure on discretionary spend in general, and I think IT spend in particular. So a little bit of a growth slowdown can be anticipated. But the question is, will it be more than offset by the improvement in valuations? We've seen improvement in profitability. We've seen almost a 300-400 basis point correction in EBITDA margins in the last couple of years. So I think there's an opportunity to claw back some of that. So I think in general, IT will continue to do well. So it comes down to valuations. And I think mid-cap valuations still appear a bit stretched. But when you look at large cap and small cap, I think there is enough of a opportunity at a stock specific level.
That's interesting because, I was looking through your funds, I mean, you do own a clutch of IT companies like Sonata and First Source and eClerks. You don't find valuations elevated in the space that you address in the mid-cap and small-cap IT baskets?
So we find a lot of small caps today available at 10 to 15 PE on a 1 year forward basis. And some of the names you mentioned fall into that category. So I think small caps still offer reasonable value. I think large caps have corrected to some extent, at least, and coming closer to their historical valuations. I think the stretch really is on the mid cap side, where businesses have done well, but the valuations are at a meaningful premium to where these companies have traded at historically. So I think it's a mixed basket. And I think this is true for a lot of sectors. And this is a point we keep making. We may or may not like a particular sector, but that doesn't mean that we can't drill down at a stock specific level and find opportunities. So whether it's a sector we don't like, we'll find companies that we do, and vice versa as well. So I would say in IT, to sum that up, I think the large cap and small cap are better hunting grounds as opposed to mid caps.
Broadly, since you are a mid-cap and small-cap specialist, if I can call you that, two of your larger funds are in that space. Given the recent underperformance of mid and small caps compared to large caps, do you find more or greater value there? Do you think mid and small caps will close that gap with large caps soon? Or given the earnings realities, that might take some time?
So if you look at beyond just the last 1 year, if you look at it from a slightly extended time frame, mid caps, if you look at Nifty trades at a 15-20% premium to its historical 10-year average. And small cap is also at a similar level of sort of 15 to 20% excess compared to the past. So that's not a very significant premium. It's mid caps really where the premium is much more. So when you go to mid caps, that premium extends to 25-30% for the index in general, and it's true for stocks as well. So I would imagine that large caps and small caps are more fertile hunting ground for ideas as opposed to mid caps, where we are restricted to 150 companies by definition. And if you assume 10, 15, 20%, 10, 20 of those names are not investable for a variety of reasons, liquidity and so on, then that universe narrows even further. So I think small cap still gives you a lot of opportunity. There's still a lot of misunderstanding. There are a large number of businesses of all types, good, poor, and so on. So I think small caps I still believe is a fantastic opportunity over an extended time frame. And I think large caps, even today, even though Nifty may trade at a 15, 20% premium, almost 45% of the index trades at below its 7-year average PE. So again, it's a barbelled kind of market, and you can still pick and choose certain sectors which are attractive and avoid those which are excessively valued. So I think small cap and large cap, I would continue to have a preference for. I think mid cap one has to be tread a little bit more carefully.
Let me ask you about another sector, Chirag, which has been in a lot of scrutiny of late, which is public sector banks. I mean, they started performing after many, many years, and they caught up really quickly. And now a lot of people are questioning whether they deserve to be bought at these kind of levels post-rally. But I saw Bank of Baroda in one of your top 3 holdings in one of your funds. Should I assume that you continue to be optimistic about some of these PSU banks?
So I think in general, we are constructive on the financial services space and banking in particular. And I think it's important to point out that banks have seen a tremendous improvement in their fundamentals in the last couple of years. So of course, we know that asset quality has seen a sharp improvement, and NPAs, which had peaked at 5-6%, have now come down to 2-3%. So in that sense, asset quality is in a far better place. At the same time, capital adequacy, which used to be 10-11%, has gone to a decade high of 13-14%. So in that sense, bank balance sheets are a lot stronger. And growth, which was anemic at 7-8%, is now bounced back to 16-17%. So you have better growth, a stronger balance sheet, and NPAs which are under control, which means banking in general is doing fairly well. Now, within that, to break it up between public and private, I think we're looking at valuations from a 10-year perspective. And the last 10 years is when the financial system, or banks in particular, we've seen depressed valuations. So we are comparing valuations to a 10-year period when valuations have been on the lower side. So I think we have to be a little bit careful of that. So just because something looks at in line or at a premium to the last 10-year average, is the 10-year average relevant? So one can argue that the 10-year average itself is not fully representative because it is lower than normal. And also, let me just a further point on that. I think there are all types of public sector banks. There are well-managed ones and there are not so well-managed ones. So I think we have to pick and choose franchises which have strong liabilities, which have strong management, which have strong distribution, and focus on those and avoid the ones which tend to be much more cyclical in nature. So I think it comes down to a very stock-specific approach within banks. But I do believe that there is a there is a lot of further room for banks to perform going forward. There will be some pressure from a cost perspective because the deposit franchise is clearly not growing as quickly. But I think in general, we remain quite constructive on financial services.
There's another sector which has traditionally been a very happy hunting ground for mid-caps and small-cap investors, which is auto ancillaries. I mean, you own a cluster of them, of course, across your funds. But would you say that that's a place where you still find value and, more importantly, a good earnings runway for the next 2 or 3 years?
I think I'm very positive still on auto ancillaries. For the one of the key reasons is we find these to be very well balanced businesses. So they tend to be, well diversified across OEM and aftermarket. They tend to be well diversified between domestic and export. They tend to be well diversified across segments, that is four-wheelers, two-wheelers, three-wheelers, and so on. So compared to an OEM, which tends to be much more driven by a particular part of the auto industry. So obviously a two-wheeler is driven by two-wheeler and so on. I think in ancillaries, the business is much more diversified. It tends to be much less cyclical. And I don't think that is fully appreciated. I think the cyclicality of OEMs is very often immediately translated or transposed onto mid-cap and small caps. But these are businesses which are far more diversified with, I think, more stable ROEs. And I think valuations, if you pick and choose, there are reasonable valuations out there. So it's a segment I would remain constructive on. But again, it has to be a very stock-specific story.
But in this space, would you be preferring the ones which are more geared to the domestic market? Because many of these auto ancillary players are actually significant exporters. Given what's going on in the global space, is your preference for the domestic facing auto ancs or even the exporters?
So I think in general, we would prefer domestic facing businesses. Obviously, the Indian economy is doing far better than what you see outside of India. So to that extent, being domestic centric is an advantage. So I think that's one part. The second is we are wary of EV, right? Because EV is certainly a big trend which is likely to take place over the next 5-10 years. So we want to look at businesses that are well positioned from an EV perspective. Are they coming out with new products? Is the current portfolio well insulated and so on? So I think we keep EV at the back of our minds. We keep the fact that domestic is a better business at the back of our minds. But even within exports, there are all types of maturities. There are some auto ancillaries which have large, mature export businesses, and those will be at risk. But there are others who are challengers. And if you're a challenger and you have 2, 3, 4% coming from exports, and if you still have low market share amongst tier 1, tier 2, and OEMs, then you can still grow. So it's not that we will avoid a business simply because it has an export orientation. We just want to make sure that they're with the right vendors. There's an opportunity to grow market share. There's an opportunity to enhance that business over a period of time. But in general, we are constructive on auto ancillaries.
What about defense? I mean, that's another space which has performed quite well over the last 6 months or so. But I know that you own a couple of defense names as well. But, this has been a sector which has flattered to deceive in the past. I mean, there have been many calls for a big play out in defense, and for 2 years, nothing happens after that. What convinces you that this time could be different?
I think we are seeing this genuine push towards Make in India. We're seeing a genuine push towards indigenization. And we can see that in order books, right? So this is not only a conversation or a story. It's reflected in the kind of order books that you have for large defense companies. And they're sitting on visibility for 2 years, 3 years, and so on, depending on which company you look at. So I think in that sense, the outlook from a growth perspective is reasonably sanguine. I think the outlook from a margin perspective is also okay because commodity prices are easing and so on. I think the key challenge is going to be on valuations because defense companies are now at valuations which we've not seen for a long period of time. So we always have to be careful when we say that this time it's different because usually it's not. So we have to be a little bit wary on that. But I think the opportunity for this segment is significant. And you can see that already in the kind of order books, like I said, that companies are sitting on. But valuations is the key concern.
What about something like hospitals, Chirag? Because I know you own a chunk of Max Healthcare, but Max and Apollo and these kind of names have been doing quite well. Is defensible given the kind of levels that they're trading at?
I think both hospitals, and I'll add another sector to that, hospitality, both these segments are today doing extremely well. They are sitting on levels of occupancy, which gives them a lot of pricing power. And the supply is limited. You've not seen major addition to hotels in the last couple of years, obviously driven by COVID. And I think the same is true for hospitals as well. The supply is limited. The demand is extremely strong. And India is still a highly underpenetrated market from a hospital perspective and even from a hotel perspective. So I think these segments will do extremely well over an extended time frame. But the question is, what prices are we paying for these businesses from an EV/EBITDA multiple or from an EV room perspective or what have you? And I think those valuations are again getting to stretched levels. But I think the underlying momentum in both hospitality as well as in the hospital business, in both of those, the fundamentals are very strong.
Yet you would avoid something which is related to this space, like diagnostics?
I think that space is getting disrupted a lot more. You don't have valuations in your favor. By and large, these are expensive businesses. You see a lot of new entrants who are getting in there, and the Tata 1MG and so on. And I think that can lead to a shakeup in this business. So I think we're a little bit more circumspect when it comes to diagnostics. We'd like valuations to be more in our favor than they are at the moment.
Before we continue our talk about other sectors, Chirag, let me ask you whether you think that if next year turns out to be tricky in terms of earnings growth, I mean, there are some negative surprises on the earnings front. Do you think there is a room for valuation compression in the mid-cap and small-cap space? I know you said that maybe it is more for mid-cap than for small-cap, but they generally tend to move as a cluster. Are you cognizant of that risk, or are you fearful that something like that might play out from these levels?
I think that risk is out there because when you, on one hand, India has done quite well, and our valuations have moved up by 20-30%. And at the same time, the valuation of most emerging markets and developed markets has moved down by 25-30%, which means that India's premium to other markets has expanded to a level which we've not seen for a long time. And we are trading probably at, I think, 60, 70, 80% premium to emerging markets compared to an average of 40-50%. So clearly, India has done well as an economy. India has done well as a market, and hence our valuations are certainly stretched. Now, within large cap, mid cap, small cap, I think it is less stretched for large cap and less stretched for small cap. But your point is right. If the market were to correct, typically you'd see small cap correcting more, mid cap a little bit less, and large caps tend to be the most defensive. So I think that narrative is unlikely to change. But again, if small caps are reasonably valued and we see a market correction and those valuations become more sensible, then I think that would present a good opportunity.
How is the mutual fund fraternity doing? I mean, you'll be a good person to ask this question too. In small cap and mid cap investing, vis-a-vis PMSs, because a lot of HNIs tend to feel, for correctly or incorrectly, that PMSs probably are in a better position because they can be more nimble, they manage smaller amounts of capital, and therefore the chances of getting higher alpha from their mid-cap and small-cap funds is better than maybe some of the traditional asset management companies like yours. What would you say to that kind of an assertion?
So we've seen that performance in PMS schemes has been volatile. And even today, when you analyze PMS schemes which have been around for more than 5-7 years, I think only 10 or 15% of them have outperformed their mutual fund peers. So I think it's difficult to identify a sensible PMS manager and to hold on to that portfolio for sort of 5-10 years. And I think a lot of them are gaining in size. So they're not, a lot of these are not small in size as they used to be. And even the ones which are smaller in size, I'm not sure whether they leverage their size to their full advantage. But I think there are certainly some high quality PMS schemes out there. But at the same time, there are a lot of those who have volatile performance, who do extremely well in bull markets and then tend to give up a lot of that performance in bear markets. So I think you need to have a strong person at the top. You need to have a strong team. You need to have good management access. And not all of that is easy when you have small scale. So I think there are some managers which certainly add value, but I think in the excitement to look at customized portfolios, sometimes we don't realize that it's not that easy to outperform when just because you happen to have a curated portfolio.
Have you ever felt that managing a 20,000 crore small cap fund is a bit of a disadvantage to you?
We've always said that, our fund size may be large, but let me give you the example of our mid-cap fund. Our mid-cap fund is 35,000 crores of assets under management. So we're certainly the largest out there. but our weighted average market cap is the lowest in the industry. So we're a large mid-cap fund investing in genuine mid-cap and small-cap companies versus a lot of our peers where the AUM may be smaller than ours, but they tend to invest in much larger companies. So the size is one aspect, but how do you use that size? Are you using that size to your advantage or not is a question. I think we are managing our size quite well. Similarly, in small cap, we may be the third largest in terms of assets under management, but our weighted average market cap, again, is amongst the lowest in the industry. So just because we are large, it's not that we have gravitated towards large caps or larger mid caps or larger small caps for that matter. We have stuck to our knitting. So I think we have used, despite size, so I think size is one variable, but there's so many factors at play, right? It is getting sectors right, it is getting stocks right, it is having, obviously style plays a role and so on. So I think size is one ingredient in performance, but it is not the only ingredient. And even within that ingredient, how do you sort of utilize it is also quite important.
Now, broadly about manufacturing as a space, when you're looking at that, and there is a lot of talk about this China plus one opportunity, if you could identify 2 or 3 sectors, spaces, where you see the story actually playing out along expected lines, generating good returns for shareholders. I mean, minus the hype, because all sectors are getting colored by the same hype now, and to ride if this manufacturing theme actually plays out.
So you are seeing it in certain areas, right? So I think specialty chemicals is clearly one area which has played out to expectations. But the problem is that stocks have run far ahead of themselves in a lot of cases. So the business is doing well. The China plus one story is playing out. But the question is at what price? Then you have garmenting as another example where India is benefiting from the China plus one movement, but these businesses are still overall not doing as per our expectations. So I think you have to, it's nice to have a theme out there which is supportive, but at the end of the day, you have to get very, very specific to that individual business, to that individual management, and play on that as opposed to the overall theme. But I do think the China plus one theme is playing out for a variety of reasons. It's not just it's political diversification, it's supply chain diversification. And I think, we are finding more and more companies coming out and telling us that they're getting a lot more inquiries or they're getting a lot more orders. And the China plus one story, which was historically just a story, is now actually playing out on the ground. But it is still, I think, early days.
Chirag, wonderful to hear your thoughts today. My best wishes for HDFC Mutual Fund under your stewardship. And thank you very much for taking time out today.
Thank you, Udayan. It was a pleasure.
If you like the video, do like, comment, share and subscribe.